Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today I'm going to be taking a look at Palantir stock and also talking about why the indexers in the S&P 500 are not going to perform as well as a decent person who is picking their own stocks. I'm going to use this request for Palantir to kind of show some of the research that I've done on this topic. And show you a couple of the ways that individual investors who are investing in index funds like the S&P 500 are basically getting out traded by professional traders, and how it's really a structural problem, I think. And the only way that a person can kind of mitigate it is to select their own stocks. As always, this is not individual investing advice. This is just how I analyze stocks. And I have some of the research that I'm going to show I have in the full Cyclical Investors Club service over on Seeking Alpha. If you join my Patreon at the $5 tier a month level, you can get a big discount if you ever decide to join there. So those links are down in the description. And this is kind of one of the side things that I do. One of the nice things about having a subscription service instead of just writing financial articles, which is what I've done for a long time, is that it gives me a little bit more time to do, research that nobody else is really doing on behalf of the members and individual / retail investors. And this is one of the bigger ones that I've come across that I've never heard anybody even talk about it before. So Palantir kind of sparked this. I've been talking about this for a while, especially I had requests for like Supermicro Computer, which also fits in this category. Tesla is a very big one that fits in this category. But long story short, basically there's two kind of pretty standard ways that individual investors are losing money to Wall Street, professionals. One is through, I think Palantir had a direct public offering, but one way is through via IPOs and hyping those up, and then getting people who are buying actual individual stocks, individual investors, to buy those IPOs or soon after the IPOs come out. While insiders are basically selling and cashing out, and early investors are cashing out. So it's kind of like a hype train, basically, where they bring the public investors in so that the private and early investors and insiders have a chance to cash out. Now, sometimes, if it's a good business over time, it's okay. The business will keep growing and making money. But I have a pretty hard rule that I never buy a stock within 2 years of the IPO. I mean, it's just like a standard rule. And we kind of see it with, there's tons of them that have like crashed. But since I usually make videos on stocks that are in the S&P 500, this one, Palantir, popped up. And let me switch this here so we can. So they had a direct listing, which is a little bit different, but it immediately jumped up to like $30 a share. And then what usually happens is these businesses keep issuing more shares and diluting shareholders, basically cashing out, while the stock price is trading at elevated prices. At least that's the goal. And there's nothing like fundamentally wrong with this. It's just kind of how the system works, right? Say you're an early investor in Palantir or any of these IPOs, you wait 10 years or something for them to go public, and you finally get a chance to cash out or diversify your investments. Or if you're working, at Palantir and you have a bunch of shares, a lot of your money would be wrapped up into one business. So it makes sense that you would want to diversify that and sell some of that. So I don't really have a problem with the way that that's set up. It's kind of always been that way. But what I would say is, as an individual investor, you don't want to be the one that's doing it, because 90% of the time, you're going to have a decline. Like, I won't pick the actual top. I'll just pick like immediately after that. This is like 1 month after it went public, or 2 months after it went public. And then you go 2 years later and the stock price is down 75%. And a lot of the people that bought in during this time period will sell. Well, you know they're selling because the stock price is down. But Palantir's diluted its shareholders by about 20% since it became publicly listed. And so there were definitely people cashing out during this time period, or the business was issuing shares and keeping the money. So, and this is very typical. This is like totally normal. What's not normal is for the business to then go on and get added to the S&P 500, which within 2 years, which is what I'm actually going to talk about here. So that first initial IPO thing is one issue, but plenty of people will talk about that. What people aren't talking about is all the traders that are front running the S&P 500 edition. I mean, this isn't a secret either. I mean, investors are trying to do this. They try to anticipate which stocks are going to get added to the S&P 500 because there's all these buyers that are buying index funds or just buying funds in their 401k who literally have no clue what they're buying. Or if they do understand what they're buying, they have no clue about valuing it and what they're paying for it. So because the S&P 500 has a very big flaw in that it's based on market capitalization minimums. So I think you need to be about 14.5 billion the last time I checked in order to be, and then you need to be profitable for like a quarter, and it has to have risen over a year or something like that. They have some basic quality measures in place, but everybody knows what they are. So if you can anticipate what those are ahead of time, that a business is going to become like GAAP profitable, like basic earnings here, and what you can do as a trader, a group of traders, is if you have a $7 or $10 billion company and you start buying it, well, you can get it above that $15 billion threshold, and then it has a very high probability of being added to the S&P 500. And then, of course, all the people that run these businesses that have a bunch of insider shares, there's nothing they want more than to have like a super liquid market of, ignorant buyers, basically. And the buyers are basically putting their stock selection in the hands of the S&P 500 committee, who are basically just running on these rules that they have, that everybody basically knows. So it creates a situation where, good traders can totally front run this. So with Palantir, if we just go 12 months back, I'm not even going to pick the bottom because I did some research this summer where I looked at this and I'm going to show you it. So the stock is up 140% in the past 12 months. That's actually almost exactly the average of what stocks run up in the 12 months leading into their addition into the S&P 500 index. So let me see here. So I did this summer, so these numbers aren't going to be perfectly accurate for, this month, but like 2 months ago or 3 months ago, they were. So I went back like 4 years to 2021, it looks like is when I started. Let's see. No, September of 2020. So yeah, almost exactly 4 years. I did research on every single addition to the S&P 500 since then. So this doesn't have the two recent ones with Dell and Palantir, but I think it has the rest of them. And so there's 54 stocks here, so a pretty decent sample size. And this was a big outlier, and these guys weren't trading. Let's actually pull them up on the fast graph so I can show you, because this was a big outlier. So Constellation Energy, I don't know if they were part of another company or not, or what the deal was, but they weren't, they really weren't public long enough to have like a big run up ahead of time. Let me see when the 222 when the addition was. So yeah, they hadn't barely been trading. Yeah, they went directly in almost, right? So right here, they went directly in. So the market was unable to front run this basically the way they normally would. Maybe it was spun off of something or something like that. And so in this case, the returns after it was added to the S&P 500 have been excellent. And that they've been up like 300%. So this was kind of an outlier because the traders didn't have the opportunity to front run it, which is pretty interesting. So we'll take that into account a little bit later. But if we keep it in there, out of these 54 stocks, these are annualized returns, except for the ones that had less than a year's worth of data, where I just used the straight up total return data. The annualized returns were 5% a year, which is very low compared to the full S&P 500 index over the same time periods was 15 point. So, and then if you take out the Constellation Energy, this is more like 3%, basically which is what the inflation rate was. So the real return from over 10% of the S&P 500 index now, if it's equally weighted, since their addition in the past 4 years has been nothing, like flat. While at the same time, the S&P 500 was up about 12% inflation adjusted a year. So that's massive, massive underperformance. So now in the 12 months leading into the inclusion into the S&P 500, this same group of stocks, the ones that had 12 months worth of data, okay, some of them were like this, these are like GE spinoffs, and some of them are spinoffs like that. But the ones that had 12 months of data leading into their inclusion, they actually ran up 133%, exactly what Palantir has run up basically in the past 12 months. At the same time, the wider S&P 500 only went up 16.7% when I did this analysis. So what's happening is traders are anticipating the stocks that the S&P 500 will put in. The S&P 500 they put in some really dumb stocks. Like, I mean, just really dumb ones. Like Supermicro Computer, which was clearly in, a bubble. Let's just put it this way. There is no valuation going on at the S&P 500 committee that adds these stocks on. They're totally brainless, if you ask me. And then, of course, the people that are buying the indexes are too. So when you put that together and then you have a system that's set up that can just easily be exploited, then this is what you get. And so what happens is, now the reason nobody's noticed this is because the huge businesses that make up the bulk of the S&P 500, the Magnificent Seven or whatever, they've held up well, and they've already been public for quite some time. The only other example is Tesla. Wasn't added, but it has produced poor returns. I actually have it in here, and again, this is from a couple months ago, but so they actually kind of inspired some of this research, because basically, so it ran up 700% before it was added. Caesars, another wonderful selection, ran up 900% before it was added. It's lost 26% per year since then. But basically, Elon got the price to run up. He got it included into the S&P 500, and then he cashed out enough money to buy Twitter, pretty much on the back of like index investors. And then since then, and again, this is from a little while ago, Tesla's lost like 8 or 10% a year. Let's just look, see where it's at now. So we can just kind of see the pattern here. So yeah, they were added, I think, at the end of 2021. Let me double check it so I don't get it completely wrong. The end of 2020. Okay, yeah, so they kept going up for a while. Let's see. End of 2020, this peak right here, basically when they were added. And since then, the stock is flat, we'll call it. Earnings eventually peaked a year later, and now they're in decline. So chances are this decline will continue, or at the very least, the investors who and again, people are buying this automatically whenever they buy like an index fund. So the volume is there where you can sell out if you want to sell out without just dramatically crashing the stock price. Especially, in today's environment where you can kind of hype things up a little bit. So Elon was smart. He took advantage of it and cashed out tens of billions. But it's all on the back of, and then, oh yeah, just the best example, Supermicro. Oops. I will get it. There we go. So these guys were added. Let's go see. Supermicro, they are down here. 3/18/24, so just earlier this year. Right there, basically. And I mean, I don't know how you can look at that and just understand that this is some sort of cyclical boom or whatever, and that it's probably not going to last. But when the stock price goes into a boom phase like this, what it does is it pushes up the market cap high enough so that it meets that S&P 500 threshold. And that's one of the problems, is this index is based on market cap, which market cap for investors mean, back in the old days, it might have meant a little something because it meant you had a big business, and maybe you had access to more flexibility and stuff in terms of funding than like a smaller business, or maybe it also coincided with it being more stable because it couldn't have grown that big without being somewhat good, right? If you're reading like Ben Graham or something, you might have something about market caps in there. But it's really a proxy of actual previous earnings growth is what is built into that assumption. And we don't really have that now. You can do, as a function of, here's the thing. If you go to small caps, there's a lot worse businesses because they haven't grown very much yet. But there's also, if you apply the same earnings analysis to a small business as you do to a big business, it doesn't make any difference. And usually you're better off if all the same metrics apply with a smaller business because there's more room for it to potentially grow. So this idea that we need to break anything down by market cap is totally stupid. It's really dumb. There's no justification for having an S&P 500 and an S&P 600 and an S&P 400 or whatever. There's no reason for any of that, except for, to make it easier for people to like invest in mutual funds and now ETFs, right? They're just kind of factor categories. Now, usually the higher quality businesses ultimately end up in as big caps because they grow their earnings and therefore grow their stock price and therefore grow their market cap, right? So there's a correlation there, but it doesn't, that's the market cap isn't what's causing it to be a higher quality business. It's the fact that they can grow earnings, and if they've done that for a long time, then usually that's a sign of correlates to a higher quality business. So, but, the average investor who's just putting money in their 401k or, buying S&P 500 index fund, they don't really know any of this. So it would be good if the people that ran the S&P 500 index actually had some sort of valuation metric, but they don't. And the market knows it, and the people that run these businesses definitely know it. And you can bet they're cashing out when something like this happens. All right. I think Supermicro Computer had convertible shares or something that they issued. I was reading, but I'm not just picking on them. It's not really. I mean, as an investor, you have to assume that this is the way that kind of things operate. And in order to get a chance to buy the good companies, you know, like Meta or something like that. I mean, I'm long Meta, but that's not really the reason I'm pulling it up. I'm pulling it up because I can actually pull up their when they. So if you look at them, like they went public. I remember they dipped. Let's see if I can go all the way back. So they went public back here. I didn't own them back here. I didn't buy them until like 2021, like right here. And if I remember correctly, the stock initially dipped. It's going to get dwarfed on this chart. Yeah, so it fell 50% right off the bat. Again, that's normal for an IPO. But eventually, they started growing earnings at 3,000% and 81%. And, you know, they grew earnings really well. And that caused the stock price, you know, to rise over time. So there are definitely Meta insiders that have sold shares over the years that have done well, but they managed to grow the business fast enough and long enough that it was enough to overcome that, even though it initially did lose 50% of its value after that IPO. So that's what the successful ones look like over time. And in order to have access to the accessible ones as a public investor, you have to have incentives there for people to take those risks, right? So I don't want to smash the whole system or bash it, but what I want individual investors to understand is you really do need to learn a little bit about valuation. And you need to understand that all along the way, people are going to be, for everything you're kind of ignorant about, somebody is going to make a little bit of money from you, especially when you're investing. If you have a money manager, and they're going to make fees, but you also have insiders that are going to make money on IPOs, and then you have traders that are going to make money both when you have a sell-off. Let's go back to Palantir. So there's short sellers all in here. I don't even have to go look at what the short interest was here. I guarantee you it was high. So traders were making money off people that were selling and panicking here. And then they got back in, especially here, once it looked like they could get added to the S&P 500, and then traders made money here again. Usually those are the pros that are doing that. They're not, you know, and I don't have the evidence to actually show it, but I read enough, and I do this every day. I get a pretty good feeling for the reasons people are buying things sometimes. And I guarantee you, if you go back and you read comments and stuff on people that were writing about Palantir and you were looking like right in here or right here, they weren't saying, oh, it's the inclusion into the S&P 500 index is the reason why I'm going to buy the stock and make a 200 or 300% return. Yeah, that wasn't the reason, right? So yeah, I mean, there is some evidence that, you know, you get out traded. Now you can, I think the best way to try to, you know, beat traders or get around some of this is simply to have a couple of rules. One, don't buy IPOs within 2 years, 2 or 3 years. And two, the traders are going to trade the short term. And the way you can potentially win is by playing a longer time frame game, right? So if you go back to Meta, maybe, I don't plan these videos out too much in case you noticed. So here's a trader situation, which I actually had. So I told you I bought, I think I even made a video on Facebook here. I mean, for Facebook on YouTube in January of 2021 when I first put out, for a quarter, I put out like a bunch of videos and I stopped until 2023. But, so the traders were right during this sell-off. I mean, you can see their earnings collapsed. And for a while, you know, I was down over 60% in this Meta position. But when I bought it, I committed to holding it for the long term because I thought they had a dominant enough platform that they could work through whatever the issues were and then come back. And that's what they did. They came back faster than I thought they would, actually. And I didn't know they were going to sell off 60%, obviously, or I would have waited. But the point is, you know, you play the long game. I'll go back to that same kind of spot here. And now, you know, just buying and holding up over 100%, that's up over 100%. So by doing nothing, but a lot of people sold. And a lot of people got scared. They didn't believe their thesis. They decided the whole Facebook going to Meta thing was a bad idea and hated it and sold it. And that's why the stock sold off so much. And then Meta, cut a lot of costs and they were able to have earnings come back. And then we have the whole AI thing now. So, but the point is the short traders, probably made a lot of money here, and folks have made money since going down there. But even though I didn't know any of that was going to happen, I just decided I would hold this one long term. And so on a time frame basis, I mean, if you're up 100% in 3 years, yeah, that's a 23% CAGR. That's totally fine. So usually the time frame is the best way, I think, for individual investors to beat the traders, basically, because you're never going to have as much information and have as fast of tools as they do on these short-term moves and these momentum-based moves. So, but if you can just kind of stick it out through that, if the business quality is good, you can have strategies that kind of go. That's what I try to do. So avoid the really bad mistakes at the beginning of the IPOs, and then I've been sifting through a lot of these businesses since then and picking up some of them after, hopefully before that they rise, for the long term. All right, hopefully that is something to think about for everybody. It does talk my book a little bit because I talk about buying individual stocks and I'm not here selling ETFs or anything. But I strongly believe everything I said was in spirit, correct, whether it's something that benefits me or not. Okay, if you found this useful, hit the subscribe button, hit the like button. I do a lot of individual stock analysis. You'll see, I think I have over 100 on the channel now from this past year. I also have a free tier over on Patreon where you can see all these videos that I post on YouTube plus others. And I'll see everybody later. Bye.